So for today's talk, I'd like to welcome Clea, who is partner and head of science at Lowercarbon Capital, which is the Chris Sacca founded US VC firm, but which also invests in European climate tech. So Clea has a PhD as well as being an investor, a PhD in chemical engineering and energy policy. And she also previously founded her own startup, which was focused on clean cooking fuels. So a great person to hear from today. So we've got half an hour. We're going to run through a load of topics, from an overview of the funding environment at present to practical advice on fundraising. We're going to look at policy stuff, particularly some things on the IRA bill, which I think will be interesting for everyone, and then some forecasts for how things will look across the next 6 months to a year. I want everyone to be really, I want this to be interactive and people to get involved. So you can submit questions through the Q&A function as we go along. You can also vote, upvote questions if you think one should be asked more than others. That we'll take them as we go along, and then at the end I can do a bit of a specific Q&A section if there are a lot. So yeah, welcome Clea. Thank you for being here. It's great.
Thanks, Freya. Good to be here.
I think we should start then by kind of an overview of what the state of play looks like. I guess, 8 months through 2023? And perhaps you want to position Europe versus the US and how funding has looked in different places across 2023.
Sure. Yeah, I'm actually going to split it, I think, more broadly in like climate tech versus tech investing more generally. What we've seen in the last year, so I say Q1 and some of Q2 2023 data versus this time last year, is that there's been significant amount of decline in venture capital investing overall and globally. I think it's something like 50%. Mm-hmm. And that's been reflected across across the US and Europe and the UK. That said, climate tech has been somewhat shielded from that. We've seen some, looking at numbers from last year, there is overall something like a 40% reduction in financing in climate tech, but that is lower, or that is a smaller decline than in the overall market. And some of the reasons for that and the tailwinds are ultimately because, and what we at Lowercarbon Capital focus on, is the fact that climate tech is increasingly understood and viewed as representing some of the largest financial opportunities that exist really in the world. I think at some point we're going to start abstracting tech from being climate tech specific, but if we're talking about things like making cement more cheaply than you would in the current process that relies on fossil fuels, and all of a sudden you're tapping into a $400 billion market, that's pretty appealing. Similarly, if you with alternative energy generation processes that again aren't subject to the volatility that we've seen in fossil fuel prices over the last year, those are trillion-dollar markets. With food and fertilizer in particular, and we've seen an enormous amount of volatility, again being driven by energy prices going up, and the kinds of technologies that are encompassed within climate tech are technologies that are ultimately not are moving away from being exposed to that kind of variability and providing alternatives that are cheaper, and in many cases more locally available, and not kind of reliant on supply chains that that have also been disrupted. So I'm optimistic and excited to see a lot of continued investment and interest in climate tech. We have seen, I think there's, interestingly, seed investments in climate tech have continued to grow in value and number, and that's compared to a decline in seed investments across the rest of the venture capital space. But when looking at later stages, particularly around growth and Series A, we've seen those numbers go down. Some of that is really kind of just like a readjustment of the market and adjusting to technical milestones or just company milestones being met, and we can talk about some of that. but otherwise, I think that represents an opportunity, a gap and an opportunity in the investment landscape for growth stage investments.
Yeah, I guess even before this kind of funding dip, there was the Series B plus gap. Do you think that there are funds, because I know there's been so many seed and pre-seed funds set up, do you think there is this gap filling capital coming for the later stages? Like, are you hopeful that that could be on the way? Or?
Yeah, I think there's, I mean, part of it is just like coming back to I think a new way of thinking about hard tech and deep tech, not just investing, but also just company building, and how you break out different forms of risk, whether it's commercial risk, team risk, technology risk, market risk, and breaking those up somewhat more gradually, I think, is what's really going to unlock a lot of opportunity for later stage investments, to later stage investors to better understand how to participate in those kinds of investment stages. We're also seeing, I think, excitingly, an uptick in a small uptick, but an uptick nonetheless in kind of capital that is focused on first of a kind investment. So supporting hard tech companies in building kind of their first commercial demo facilities, and preparing them for unlocking other forms of capital that are less dilutive, like project finance. So
I want to, later on when we get into kind of more practical advice, I know that you want to talk about kind of alternative funding sources and that stuff, which I think will be helpful for people. Are there, just on the kind of overview of the year so far, are there any sectors, you've mentioned some sectoral breakdown, but any sectors that have been particularly kind of shielded from the dip, or any that have suffered more than the rest?
Yeah, I mean, again, I think companies and opportunities that are really responding to overall crises, if you will. So the food crisis in particular, I'd say in particular things around fertilizer production, alternatives to fossil derived ammonia based fertilizers have definitely seen a lot of interest. Critical minerals and alternative forms of mining is an area that is continuing to see a lot of growth, for probably obvious reasons, but essentially that critical minerals are key to the energy transition, and there is also an increasing focus as well as incentives around critical mineral supply and production and supply that is more local to North America and Europe. That's also reflected in policies and government incentives that are going towards critical mineral production locally. Something like the Inflation Reduction Act includes pretty substantial incentives around manufacturing of batteries regionally to the US, but also specifically the kind of components for battery production coming from either North America or kind of states within some sort of free trade agreement setup. So the other one that I'd call out is energy generation more broadly, kind of responding to a lot of the energy crisis, a lot of the really big fluctuations in energy prices that we've seen over the last year. So new energy generation types, but also energy storage. What's really interesting about just looking at the last 5-10 years of energy supply is that renewable energy generation has declined in cost really significantly, and that has been responded to with an increase in supply and building that out. And particularly in the last year, I mean, the growth has been, I think, really unprecedented. In subject to the war in Ukraine, but what that also means is that the value of adding new renewable energy generation, particularly things like solar and wind, is going down, and what that translates to is that energy storage value is going up, and I think there are a lot of really interesting opportunities there. The last one in that kind of realm, and there's so many more, but that I'm super excited about is just seeing a lot of innovation around distributed energy generation. So how do you better match growing in various types of energy demand, like from electric vehicles or electrification of homes, with the appropriate supply, and also how do you manage that demand to better match energy generation supply. So yeah, it's been really awesome to see a lot of growth in those areas, and
Cool.
there are many more, including carbon removal, which we're seeing
Yes.
seeing growing demand around that, and that is being seen with growing supply. Still need more, and that's an area of focus for us.
Yeah, I guess the term climate tech is now just like infinitely growing. It covers
It's so broad. It's so broad. There's so much. Yeah.
Yeah. And then, yeah, onto kind of practical advice. I think that would be helpful for people. And a reminder that everyone can put questions in the Q&A and I will pick them up as we go along. Do you want to talk about how, if you were a founder, you would kind of alter your pitch deck for going out and looking for funds in this current economic environment we're in now? How would you kind of approach that?
Yeah, it's a great question, and there's not any one way of doing it necessarily, but one thing that we've definitely seen evolve in the last year, and kind of a recovery from the 2021 boom, is less appetite for uncertain outcomes, and that doesn't mean that there's less appetite for the same kinds of companies, but it just means that that founders and investors need to kind of change the way they're thinking about how they want to see and understand milestones that companies have kind of achieved. So on the one hand, it's there tend to be technical milestones often in climate tech that, how do you speak to those, and what do they mean from a de-risking standpoint? How can an investor understand what you've achieved to date and what that translates to in terms of being having less risk in what you need to achieve next. Similarly, for commercial outcomes, are there ways in which you can get your customers to buy into your product sooner? There are ways that they can commit to your output, with some amount of kind of skin in the game, and the rest of it coming later. Basically, I think there's in general just less appetite for. There is more need to show real product market fit early on, and even though a market is very large, and I think all of the markets that I've highlighted are colossal, there is still somewhat of a gap in understanding between capturing those markets and actually or like those markets being there and actually capturing them. And so the more a founder can translate what they are doing and what validation they've gotten for being able to tap into that market, the stronger their pitch is. Obviously, this evolves over different stages. And the more capital you're asking for and the more capital you need, I think the closer you need to get to really being able to kind of push your customers to give you commercial contracts that can be viewed as some sort of like, de-risking. Then there's obviously team de-risking, and I don't think that's changed so much necessarily, but being able to speak to, I think there's so much in climate tech that is verticalized, because there's so much value to gain, but also because a lot of this is new. And so being able to speak to how you are de-risking that verticalization through certain types of hires who have had that experience before, or just certain partners that you're engaging with to be able to do that, I think is really important. And the final thing I note is just like the big picture, the kind of question behind the question that your investors want to, or the investors that you're speaking to want to know, regardless of the stage that you're at, is how much capital do you need to hit that $100 to $200 million revenue mark, and where are you going to get that capital from? So there's probably some shying away from very capital intensive things, but I wouldn't say that to discourage anybody that is working on hard tech and capital intensive opportunities. I think those are the ones that are in some ways, some of the most exciting. It's really just about breaking down that capital need in, again, those milestones that de-risk different parts of the business, and thinking about and working with folks who can help you identify other additional forms of capital, and particularly around like speaking to project finance, for example, so that you can access debt, sooner rather than later, or government grants.
Yes. Yeah.
Yeah,
This is very related. I think you've perhaps spoken, a few points have already addressed this, but we had a question from someone asking, how can a capital intensive startup position itself to raise a seed round for infrastructure, given that VCs might not want to make that bet early on? Perhaps this is a good time to talk about the kind of alternative funding sources you'd mentioned earlier on. I think it's a good question.
Yeah, no, it's a great question, and I mean, part of it is, I think some of the reality is there are certain things that are going to be more challenging to go and build today than they might have been 2 years ago. I don't know that this is very different than kind of venture capital has been for a while, but how I would think about it is again splitting down that capital need, right? What is there a commercial demonstration or a pilot that you can build that shows how your technology works and gets your customers excited? I think really one of the key takeaways from what I've seen in the last few years is engaging your customers as early as possible. Without necessarily committing to something before having a product that works, but bringing them kind of along the journey and having them really be bought into what you are building is a really great way of ensuring that you have a customer at the other end, and in a lot of ways de-risking whatever capital you need to build to build the tech that you are building. And so evaluating and sizing a pilot, for example, whether it's a new electrochemical process that can make steel, and you have a particular customer in mind, and you want to bring them along the journey with you so that you have an understanding of what they'd want to see from your product, that would give them assurance that, okay, this works at the specs that I want, this works at a scale that I can understand, and I can commit to that scale up. And maybe they end up being, a part of not necessarily a part of the investment in your company, but maybe it's part of an investment in an asset that you build. But really, it's again about like de-risking that commercial outcome. Because I think the clearer it is what the commercial outcome is, the easier it is to, or the more straightforward it is to ask for a specific amount of capital.
Yeah, exactly. We have we have a lot of questions. This is great. We have a question on what the role of business angels is in climate tech, and what governments could do to encourage more business angel activity. I don't know how much you think with angels, but any thoughts on that?
Yeah, I mean, the more champions and supporters you can get, the better. Of course, there's some like deciphering of who you want to be taking advice from and why. But the more smart folks you can get around the table supporting you, the better. And that's part of that's also a reason why why we encourage setting up boards or fairly early, so that you can have kind of that mind share and folks that are specifically there to support you as a CEO founder of this company, and are able to draw on their experiences with similar companies, or different companies, or similar stages of companies, or folks that have seen companies go from 0 to 20 or 20 to 100, that can be there to provide that mind share and brainstorm, so that you can ultimately like get through those stages way faster, and you don't have to start from zero. So that's really how I would think about the folks that you're bringing around the table. Now, from a capital stack standpoint, you know, the way that you capitalize your company is, even at the earliest stages, you know, will continue to have implications down the line. What I mean by that is getting investors on board who can be a part of your journey or unlock further capital down the line. Ultimately saves you time and de-risks key parts of your business. And the mechanism by which that can be done, and this is not like a guarantee ever, and you should be clear about asking any VC this question, is through the pro rata mechanism, which is, you know, if a particular group or individual owns a particular percentage of your company through investing in it, will they continue to be able to put money on the table to maintain that ownership, and that ultimately helps, you know, supports your fundraising at the next round. So I would really, you know, whomever you're spending time with or who you're bringing around the table with you, I would both ask and get references on the ways in which they can be supportive, and the ways in which they can de-risk your capital strategy. I think that's really probably the takeaway here, is that getting that capital strategy locked in is probably going to be one of the most strategic things that can be done for a company, particularly in hard tech and climate tech.
And we talked before about the metrics, to go back to kind of pitch deck and initial meeting. We talked about the metrics you think founders should be including, and we have a question which links, I think, to this. Someone asking, how do you balance financial return on investment versus carbon impact, and how do you measure the latter? Do you want to talk about perhaps the metrics you ask and the metrics you'd collect yourself? And I think that would be good.
Yeah, I mean, the way we look at any opportunity is in the financial opportunity and market opportunity and the climate opportunity, and we look at that concurrently. That isn't always just carbon emissions. I mean, a key part of our work and our flagship funds are focused on decarbonization, but we also have a fund that's focused on carbon removal, and we also have a mandate to or a lens on investing in climate adaptation and resilience. But coming back to your question, Freya, on the specific metrics, and I'm forgetting exactly what that was. In terms of balancing the two, so ultimately, it's climate tech is and because it's essentially climate tech, as all sectors of the economy, represent I think the largest financial opportunities in the world, and that is the inflection point that we have seen. I think that the world has seen, particularly in the last few years, as technologies are now becoming available that can undercut the incumbents and fossil fuels ultimately. But if a company can't meet that financial opportunity, then they aren't able to reduce emissions in a substantial way. So those two are really are viewed simultaneously, because if you're targeting something like the chemical sector, that can be multiple percentages of global greenhouse gas emissions. Food sector is close to 20%. There's obviously different parts of that, but without the financial success, you aren't able to capture the climate opportunity ultimately. So that's really how that's viewed.
Yeah, we've got so many questions. I want to make sure we get in one about policy, because I guess it's increasingly important in this sector. So we're about just over a year into the Inflation Reduction Act in America, I guess. What do you think founders should kind of top line know about how they should be responding to that act, plus perhaps weighing it up against what Europe has to offer?
Yeah, I mean, I would think the Inflation Reduction Act has done it. I mean, is a fantastic feat, along with a lot of the other policies that came into place at the same time, and those are estimated to provide incentives on the order of trillions of dollars. But ultimately, the way that we encourage founders to think about what they're building is why is this better than the alternative, and how will I undercut the alternative? Now, what the Inflation Reduction Act has done is further boost that financial opportunity, and particularly in kind of the earlier stages of a company being built, particularly when margins might be slimmer or negative. The presence of the Inflation Reduction Act that provides incentives for carbon removal, carbon capture, clean fuels, hydrogen, advanced manufacturing, batteries, solar, wind, energy storage, that it can really boost those early day economics, and get them to a place where they're undercutting fossil fuels in an even more substantial way faster, and building those business opportunities faster. A company in our portfolio called Antora provides a thermal energy solution, for example, that displaces natural gas boilers, and particularly has a lot of traction with ethanol producers in the U.S. Ethanol is produced particularly for transportation fuel. It's mixed with gasoline, and thanks to and their economics were good, and they were ultimately undercutting fossil fuel prices, or the natural gas boilers, because in California there's an additional tax on transport emissions, but with the IRA tax credit, they can double that monetary value, and they can do that today, which is huge for being able to finance the business early. So that's how I would think about these opportunities, and there are many more of them. There are obviously incentives to build a lot of advanced manufacturing, particularly energy storage in the U.S. A good friend framed this, and I'm sure others have framed it this way, but U.S. versus EU policy incentives are very much kind of carrots and sticks. In the U.S., it's the Inflation Reduction Act is framed as credits, and there's a lot of really great new opportunities within the IRA that make those credits more reachable, versus in the EU, where arguably the EU has had climate policies for way longer and has been more advanced than that, but there are specific kind of penalties for not meeting certain standards, whether it's sustainable aviation fuels or eliminating natural gas boilers or eliminating internal combustion engine vehicles, and that is continuing to drive a lot of innovation, because there is a clear knowledge and known point in time where this innovation is needed.
Interesting. I want to talk about that way longer. I think we can go kind of 5 minutes more, because we've got a lot of questions, if that's all right. So we've had two on lower carbon specifically. The first one is, can VCs like lower carbon take a long-term view on particularly infrastructure investments? And if so, what's like the maximum range of investment time you could consider? And someone's saying, which stage is lower carbon most interested in right now? So that we can merge those questions.
Great. Yeah, great questions.
Focus.
Yeah, so in terms of timeline, our funds are standard 10-year funds. So there's no kind of like special view on that. We invest in a lot of hard tech, and our view in that is that they're going to create value in that time frame. I think we have a fund that's entirely dedicated to investing in fusion energy, and that doesn't necessarily mean that we think that there's going to be an abundance of electricity produced by fusion power plants in less than 10 years, but it does mean that we're going to recognize the value of innovation in fusion and fusion companies within that time frame. And what that means is like developing an understanding of what are the milestones that have been achieved, and why that brings us closer to a place where we have electrons coming from fusion power plants going onto the grid, and yeah, and I think we're well underway, or we know that we're well underway to start proving out energy net energy gain, which means ultimately more production of energy out than you're putting in.
Mm-hmm.
And I think those kinds of signals are going to be viewed very positively by the market in terms of what that can mean for capturing a big portion of energy supply. Now, so in thinking about infrastructure, that's where I would really encourage folks to, I mean, founders and investors alike to better understand what the options are for different forms of financing. I mentioned project finance a couple times. I mean, it's not necessarily an obvious one, but it's basically the ability to fund an asset and a project with a combination of equity and debt, and the cost of capital is very different from when you're investing and selling a portion of your company. Now, it's not obvious necessarily how you get there, but there are clear steps to doing that have been done in other industries. I think if you look into some of the history around liquefied natural gas and LNG terminals and the way that was done, essentially, you need to build that infrastructure first, show that it works. Now we can think about splitting up what size that needs to be, and right sizing that is really important, because maybe you can build it of a certain size and then kind of there's a 10x growth that might be accepted and well understood by financiers. But I think really bridging that gap both for founders and investors in how a company can and how infrastructure can get financed that way. And then in the US, there are things like the Loan Programs Office that will play the role of kind of some of that infrastructure investing. So getting a sense for what that is. I mean, again, any sort of grant financing, it takes time, but it can provide a lot of reward, especially if you can. I mean, that's non-dilutive financing that you can put towards a particular asset. Yeah, there's a lot that can be said there. In terms of lower carbon and the stage that we focus on, we're focused really on partnering with teams at the earliest stages, at least initially. And that's like pre-seed, seed. But we have the ability to grow to grow with companies as they hit their milestones and as things are going well through multiple stages thereafter.
Great. And then last question to wrap up. And sorry to everyone whose question we're not going to get around to. It's great we had so many. Apologies to those who didn't get their questions answered. Last question to wrap up then. Where do you think the next 6 months will go? What will they look like in terms of funding levels, trends, any kind of insights you're predicting for the next half a year to a year?
Yeah, I expect that we'll continue to see some of some of this right sizing happening. I think there is some continued adjustment that is being made from kind of 2021 investment cycles to today, and I think that means right sizing fundraising rounds to be very specific to mailstones and value inflection points. That's really the question that we ask, right? Is what are the curve inflecting milestones that will unlock more valuation at the next round, and focusing in on a few of those per stage. I think we're going to see that being really important, and I think the market responding better to that. And then in terms of sectors that I'm really excited about, I mean, I mentioned some. I think we're going to continue to see a lot in mining and critical minerals. I think Europe, in Europe, we're probably going to see a lot of that in kind of the recycling of metals in particular, probably in the US as well. I imagine that we're going to see a lot continue to see a lot at the kind of intersection of growing computing and energy needs, or the energy needs associated with computing, especially as generative AI and a lot of other computing functions grow. They require a lot of energy, and we need innovation around distributing that and reducing the greenhouse gas emissions impact of that. And then then kind of in a more dire version of this, but I think is just a reality. We've obviously, this is to date been the hottest year on record. We've had the hottest days on record on the entire planet. We've seen the continued extremes of and frequency of extreme weather events around the globe, and kind of understanding or having a more acute and clear understanding of the implications that has on the way people live, the way people make food, and the way people power their homes, or are able to power their homes and cool themselves and heat themselves. So I think that is going to translate to a lot more in adaptation and resilience and innovation there and financing opportunities there. Things like supporting cooling of local areas to prevent, really extreme biodiversity loss. There's some very important tipping points that are kind of coming forward, and being able to respond to that, I think, is going to be a really big topic, whether it's in innovation or policy or like general knowledge. So yeah, if there's I encourage folks who want to build to go build. This is the time. There's a lot to do, and we need folks from all sorts of background to be working on this. And yeah, I'd put in a particular pin for climate adaptation and resilience.